Okay, good morning and happy Tuesday, everyone. Welcome back to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and a lot has transpired here over the past week. So let's go ahead and get started. Before I do, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So before we get started, just a quick reminder, we've been getting a lot of questions about the election. So we're going to be doing a members only election special here this Friday. So instead of doing our normal Friday morning market outlook session, we'll be doing an election special. This is for members only. So for those of you that are members, you'll be receiving an email today and over the next few days to make sure that you can register for that event this Friday at 9 a.m. So we're going to start off today by talking a little bit about seasonality analysis. Now that we've entered Q4, let's take a look at what our expectations are from an October perspective, from an election year perspective, and the Q4 perspective. A lot of people ask about seasonality, so let's try to help answer some of those questions. With that seasonality update, we'll take a look at where currently markets stand, and that'll provide us a little bit of insights into how markets may be reacting here over the next possible weeks, the next few weeks. We'll take a look at fixed income markets and commodities to give us also a sense for whether or not we can continue to see gains here in the markets and what the fixed income markets is telling us right now, especially about the stimulus. I think there's some clues that we're currently getting from the fixed income markets about the probability of the stimulus bill in the relatively near-term future. Then we'll take a look at economic indicators as the shape of the recovery continues to improve, where we see that improvement, what opportunities we see as a result of that. And then today we'll do a full sector review before we open this up for Q&A if we have a few minutes here at the very end. I just want to make sure everyone can hear me. If you can hear me, please type 1 into the chat window. If you can hear me loud and clear. Okay, perfect. I see a lot of ones. So let's go ahead and get started. Now, the primary question that we've been getting over the past couple of days, especially as we have a lot of volatility here, now that we've seen the president's health at least stabilize here, he's back in the White House, and markets have started to at least resume that bullish trend. The question is, are we back into a bullish trend from the broader markets here? That's the primary question that I want to help answer. So those are the charts that I want to share with you here today to help you better understand where we currently sit from the markets and from the broader markets, as well as from a seasonality perspective and the economics perspective. So we'll start off by taking a look at some seasonality analysis here. Hopefully the sound is a little better now. So we'll start off with seasonality analysis here. So what we wanted to take a look at is want to take a look at what does October generally look like from a seasonality perspective. So on average, all Octobers is average of about up about 0.5%. However, one thing I want to say is seasonality, always take seasonality with a big grain of salt, because the sample sizes for seasonality, generally speaking, are fairly small. And it's not fair to say all Octobers are the same, or all Q4s are the same, or all election years are the same. We are obviously in a very, very different world than perhaps any other election year or any other Q4 from a COVID-19 perspective and the current presidential election. So take all of this with a fairly big grain of salt. So on average, Octobers are up about 0.5%. However, when we look at Octobers, when the previous month, September, is a down month, the average October is actually down 0.5%. So September was down about 4%. So our expectation here for October is about down about 0.5% on average. But when we look at this within an election year, there's a substantial difference. All Octobers in an election year is down about 0.2%, but during the election year, when September is down, October is down about 2.3%. So substantial change for an election year when September is down as to what our expectation here is for September. Again, sample size very small, so take this with a fairly large grain of salt. So The other thing that we want to take a look at is Q4, right? So we saw what October looks like from a seasonality perspective, but Q4 on record is the second best performing sector behind Q3, which is the best performing sector by far. And one of the things about Q4 is that 74% of the time, Q4s are up. So we have a very high probability of Q4 being a relatively strong performing quarter. And moreover, when we look at Q4s, when the first 3 quarters of the year are up, as you can see, it's potentially very strong. About 80, almost 82% of the time, when Q1 through Q3 is a positive performance, which is what we've seen from the markets, Q4 is up on average about 4% and is up 82% of the time. And when we look at this during an election year, it's even further. The average return of Q4 when the first 3 quarters are positive is actually 4.5% and is up 88% of the time. So very high probability of markets moving relatively high from a seasonality perspective, okay? This is only from a seasonality perspective. As you can see, sample sizes are pretty small. So we don't want to draw too many conclusions from it, but the general thesis from seasonality perspective is that we're going to see some weakness in October, especially given the current environment of what we saw in September and the fact that we're going into an election year. But because of that, we do still expect Q4 to be one of the strongest. So most of that performance will come in the form of October and December. So what we generally want to see is some weakness in October and use that as an opportunity to potentially buy that dip. That's how we're looking at this seasonality perspective. So now with that in mind, let's take a look at the broader markets. So we've been talking about the Qs for quite some time. We've talked about the 282 level here, which is the high after that initial plunge here in September. We talked about the 260 low, which is the low from that after that initial plunge. And those are the 2 levels that the markets have roughly been sideways in. Now, last Thursday, before we got news that the president contracted COVID, we almost broke out to the upside from 282, but due to his news of him contracting coronavirus and being hospitalized, that took a big dent here in the markets. Now, yesterday, that market reversed higher here, but we're not back above 282. So the question here is whether or not we have enough of a catalyst to get ourselves back above it, or we're going to fail and retest 270 and 260 here to the downside. The one thing I will point out here is that money flow has been pretty weak here. And what that means is that down days have had substantially more volume than up days. And notice yesterday's volume was pretty low here to the downside, to the upside here. So, you know, is there a catalyst for this to move higher here? From my perspective, the catalyst that could drive us higher here is actually a stimulus bill, fixed income markets providing us a little bit of insights into the probability of that stimulus bill. So one of the ones that we want to pay attention to, but markets have not resumed that bullish trend. We're close to resuming that bullish trend, but we're not there yet, especially if you look at the Qs. When we look at the S&P 500, same thing. That level is 343 to the upside, 323 to the downside. We have seen quite a bit of strength here from the S&P 500, just a few points away from breaking above that resistance level, but we have not broken above that resistance level yet. If we look at seasonality perspective, it certainly points to more likely what we see is this roll over a little bit and then use that potentially as a buying opportunity for a longer term view here going into November and December. So that is how I'm currently taking a look at the markets here because of the fact that we haven't broken back above it. But if we do break it back above it, that is our signal that we are resuming a much more bigger bullish trend here, because we have had a very strong bullish trend here since March. We've taken a brief pause here, and the question is whether this continues. And based on seasonality perspective, we certainly believe that that can very well continue. And when we look at seasonality from an even broader picture, we certainly believe that markets can continue to rally here from these levels, but it is taking a current pause here. The question is, how long of a pause are we going to take? From a seasonality perspective, it looks like there could be another month or so of a pause. Now, when we look at small caps, This is one of the more encouraging parts of the equity markets. We've seen substantial strength here from small caps, up over 2% here yesterday. So this is really one where small caps is back near that 160 level. I'll be perfectly honest, when small caps started to break to the downside here, I didn't think we were going to see 160 for a while. But the fact that we're now within spitting distance of this 160 level, which has been a strong resistance level for a long time, if we can break back above it, that really puts us back into contention into that 170 level here on small caps. So when you see small caps being part of this broader rally, that is encouraging for the health of this rally here, because if small caps lag behind while you just have a few more tech stocks dragging the stocks higher, that's not healthy. But when you see small caps part of the market, when you see equal weight part of the market, this is all gathering strength here for a potential breakout here for the broader equity markets. And RSP, equal weight S&P 500 index, starting to break out higher here and gathering strength and outperforming S&P. This is what you generally want to see going into a rally. And then if we look at emerging markets, we see the same thing. Emerging markets, we've talked about the breakdown here a couple of weeks ago here below that $44, $43 level here. It quickly reversed that back into this zone here, this neutral zone, if you will. So EEM very much back into this trading zone here, and potentially will trade likely sideways unless you have a catalyst for this to break out higher here. So some levels to pay attention to here on the EEM side from an emerging markets perspective. Another signal that we've recently gotten was the HYG. This is the high yield ETF, high yield fixed income ETF. And we saw a breakdown here a couple of weeks ago. And this was our signal that markets were taking a bit of a risk off tone, that they were selling these riskier assets, buying treasuries. We saw that shift in rotation into treasuries. Now we've seen a stark reversal here yesterday, where HYG managed to rally substantially from Friday to Monday back into this above that $84 level. And you couple that with TLT, the Treasury ETF, taking some huge outflows yesterday. This, I think, speaks a lot more towards this risk on environment that's back on. And I think this speaks really to the fixed income markets, providing some visibility into how they're viewing the possibility of a stimulus before the election. The big moves that we're currently seeing out of treasuries into high yield, from my perspective, speaks to the fact that there is a much higher probability of a stimulus before the election than what we were previously at this point pretty much pricing in, which is the fact that we weren't expecting one until next year. I think between the president contracting coronavirus, the number of uptick in terms of cases, and perhaps Congress trying to just pass some stimulus because there is substantial need for it, trying to get that across the line. And you know, the two sides are closer now. We're at 1.5 trillion versus 2.2 trillion, which is substantially closer than where they were before. Before the gap was almost $2 trillion. Now at about $700 billion. That is possibly a smaller gap to fill. We're not there yet, but that is, again, the news that I think could propel markets higher. That is the catalyst that we're looking for. And I think fixed income markets right now pricing in a higher probability of that. When we look at put call ratios, this is where we still see a fairly healthy amount of call buying. And when I say healthy, I mean extreme levels of call buying. And this is also driving some of the flows here into equities, and again, potentially one of the catalysts that could drive equity markets and propel it higher. We're likely to see continued call buying if markets break out above some of those resistance levels that I'm referring to. I think that would bring a lot of confidence to some investors that these bullish trends have started to resume. So call buying still happening at a fairly healthy clip here. When we look at gold is still below this 180 level, but as we see dollar decline here and TLT start to trade lower and inflation expectations starting to creep up a little, this is really where we could see a breakout here on gold above that 180 level and perhaps resume a bit of a bullish trend, or at least stop this bearish trend here. And I think another way to draw the lines here for gold is maybe this is a bit of a flag here that we've had, and we're looking for a breakout here to the upside. So gold really, I think back into the view of some investors here, especially if it can get back above 180. It's a little higher here pre-market here, so let's see where gold trades here today, especially with that big move out of TLT yesterday. I think this could be what propels gold above that 180 level and resumes that bullish trend. Now, when we look at economic numbers, one of the big surprises we've seen this week has really been PMI. A services PMI. So services is really the part of the market that has really lagged behind on the recovery. And this is part of because services by nature is not the type of industry that when you have pent up demand will all of a sudden, resume there is no such thing as pent up demand in terms of services. Once services are lost, they simply just resume back where they started. They don't have this pent up demand the same way manufacturing might have or durable goods might have. So services has recovered at a much slower pace. But this is the first month where we saw services employment get back above the 50 level. So we're back into expansion territory. Up until this month, services has actually seen declines in terms of employment. Services PMI also starting to continue to uptick here above the 50 level here. So we are starting to see services come back to life. And this is part of the recovery here, the economic recovery. So when we take a balance of, the different economic indicators that we take a look at, and we plug them into some of the GDP models, this is really where we're starting to see some continued revisions to the upside for GDP. We've seen revisions to GDP to the upside for a couple of months now, but I did want to give us a little bit more of an update here. So going out to 2021, Goldman Sachs now has a 5.8% GDP for 2021 in terms of growth. The consensus right now is about 3.8. So Goldman Sachs certainly on the higher end of the forecast here for GDP, but Morgan Stanley also putting out some fairly I would say upbeat views here on GDP, basically saying that based on the resilience of the recovery and the progress that they've currently seen from the different economic numbers, they're looking at GDP levels to get back to pre-COVID levels by the middle of next year, even potentially without a stimulus. And this is, I think, pretty, I would say, strong support here for the shape of the recovery and what we're currently seeing out of the economic numbers. Now, this is something that I do think is also one of those things that you need to take with a very large grain of salt, because GDP modeling is very complex. There's a lot of different economic indicators that go into it. It's much more art than it is science here. But from my perspective, the thing to take away from here is not necessarily the estimates or the forecast per se, but the fact that we're seeing major banks continuing to revise higher their GDP expectations based on the economic indicators that are coming out, meaning better than we were expecting, better than we were forecasting. That is really the takeaway that I have from some of these GDP forecasts. And when we look at COVID-19 cases, we still continue to see an uptick here since the beginning of September. The number of deaths have not increased. They've predominantly plateaued here, but the question is really whether this is going to see an uptick or a third wave, if you will, or this kind of starts to flatten out and starts to move lower here. I certainly think that what your views are is heavily contingent upon where you live and kind of how comfortable you are with getting out there. I will say that this recent uptick, I do think, is fairly nominal in the sense of this curve that we've seen. So we're certainly not seeing exponential growth, which is a good thing. And I think that is likely going to keep this in check rather than see an acceleration here to the upside. But time will tell. The number of deaths continue to decline, and I think that is potentially still good for the recovery from an economics perspective. We do hear cases in pockets of different cities going back into slightly more restrictive, but unless that gets nationwide or we start to see states go back into more restrictives, we do think that the shape of the economic recovery so far is still intact. Now, last week we got retail sales numbers, and they were actually particularly strong. They surprised to the upside again. Even though it is starting to slow down, retail sales still remaining one of the strongest. But when we break down the retail sales, one of the largest gains that we have seen came from department stores. And department stores, if you look at their stocks, have been one of the worst performing stocks and remain at rock bottom. So this is really where we start to see perhaps a little bit of recovery on some of those names like Nordstrom's and Macy's. Those are stocks trading near all-time lows. For those investors looking to pick some bottoms here, perhaps this is some news that you were looking for to signal that there is starting to be a bit of recovery here in some of these department stores. So with that, let's take a look at the sectors, the broader sectors here. So we'll start off with materials. Materials, one of the strongest sectors here at the moment here, really, a straight line up from the recovery here, fairly strong here. And recently, had that move to the downside. It has a small gap to fill here up into that $66 level. I do expect that gap to fill here over the next day or two and potentially break out higher and test that 67.5 all-time high here for materials. So especially as you see some rotation out of technology, this is really one of the sectors that has seen continued rotation into. So materials, certainly one that I want to pay attention to. Materials, one of the few sectors well above its February highs. That's not a technology or consumer discretionary. And the recent plunge did get back to the all-time highs, tested that as support, and now is resuming its bullish moves higher here. So both the daily and weekly chart fairly constructive here for continuation higher. Look at industrials. Industrials, I would say that the relative strength of industrials really didn't take shape until the bottom of the March lows here, where it started to slowly outperform the S&P 500 slowly. And over the past couple of weeks, the plunge here was actually substantially lower than the rest of the market. So also providing a little protection during that initial plunge. And the fact that we're now within spitting distance of this $80 relative high puts it in contention of potentially breaking out and retesting that $85 high from February of 2020 here. So industrials, certainly one of the sectors that we're paying attention to here for a potential breakout. So when we see this rotation out of technology, now keep in mind, technology is still one of the strongest sectors, and if the second strongest sector that we have right now. But we are seeing industrials and materials continue to rotate back into favor here as two of the strongest sectors that have seen continued strength here over the past couple of months. When we look at communications have really lagged behind since this initial plunge. It continues to trade to new lows here. It has not gotten the same type of recovery as technology and discretionary. So communications very much in more of a neutral zone here. Perhaps it'll get back up to that $62 level, but more likely to trade sideways here until it can break out here, but less likely, less strength here for a breakout here for communications versus some of the other sectors. When we look at real estate has really continued to be neutral and underperform, because as the ETF or the sector moves sideways on an absolute basis, while the markets are moving higher, what that means is that this sector is actually moving lower on a relative basis. And that is never particularly a strong case for this particular sector. So we have 37 as a major resistance level. We have 34 as a major support level. What's more likely is you will see a rollover here as it approaches those resistance levels, unless markets can really break out higher and just start to resume that bullish trend immediately. I think that you're more likely to see these types of sectors trade neutral and sideways rather than break out higher here. XLF is now trading still below its 200-day moving average. Yesterday's move in yields certainly took XLF a little higher here. Can it break out above this $200-day moving average level and continue moving higher? We have seen a very, very slow rotation into financials over the past few weeks here. Pretty much since the beginning of September, it's provided quite a bit of defense on the downside. It's provided a little bit of outperformance on the rebound. So this is really one of the sectors that we are paying attention to. XLF is the second worst performing sector in the S&P. So certainly not by any means a strong sector, but slowly, very, very slowly starting to see a bit of rotation here. This could very well fail at the 200-day moving average. Most of the yields upticks that we've seen over the past few months have predominantly been faced with immediate buying of treasuries, and that is likely what we may see here in the next few days, and that could very well get rejected at the 200-day moving average and continue to moving lower here. So XLF not quite there, but potentially gathering some strength and testing that 200-day moving average. So pay attention to that 200-day moving average for a potential breakout. When we look at consumer discretionary, this is still by far the strongest sector. It has outpaced technology now. It is back to its 150 high, which is the high it put in after the initial plunge. It did not plunge as far as the other sectors. It has retested 150 2 times. This is now the 3rd time it's retesting this 150 level. This is one that we could see a potential breakout here to the upside prior to the other sectors. So if we do see a breakout, we're likely to see discretionary lead that breakout before technology and some of the other sectors that we're mentioning, like materials and industrials, might join in on this rally. But overall, what we're seeing is a healthy amount of sector rotation. It's not just technology leading the markets higher. You have discretionary, you have technology, you have industrials, you have materials. These are all strong sectors as you start to see some of the other sectors weaken and start to continue to underperform. This is generally healthy for a market rally here. So everything that we're currently seeing from the market's perspective does not lead us to believe that this is a market top, that this is the end of this rally and we're going to start to see a move lower here, especially going into earnings season, going into election. These are things that are going to cause volatility, but this is where you can take volatility and use it to your advantage. When we look at XLP, XLP is a much more neutral tone here, hasn't quite gotten back to those highs here from that 65 and a half level, 62 to the downside. More likely to see some more of a sideways action unless it can break out higher here. XLP is particularly strong from these July highs, if you will. When the markets put in those highs in July, this is really where XLP started to outperform. It is performing on par with the broader markets here, so it's not outperforming or underperforming. So it's yet to see as to whether XLP can start to outperform. If we do get a number of rising cases in COVID-19 and we go back into more restrictive lockdowns in certain states, this is that potentially a catalyst for XLP. That is part of what drove some of this outperformance here. So COVID-19 will likely be a driver as to whether XLP starts to outperform or continues to underperform a little bit as COVID cases either uptick or decline here going forward. When we look at utilities, this is one of the, I would say, more boring segments or sectors of the market to take a look at. Very neutral, similar to XLRE, trading within a sideways range, which means that as this ETF trades or the sector trades sideways while the markets are moving higher, that actually means on a relative basis, this sector is moving lower here. So we see this major resistance level here around 62. This is likely going to fail here at the $62 level and more of a sideways action unless it can break out here to the upside. But I don't see a strong catalyst that drives utilities substantially higher, especially as yields start to tick up a little higher here, makes these sectors a little less attractive. When we look at healthcare, healthcare was one of the strongest sectors off of the initial March lows, and then has pretty much underperformed since the mid-April or so. And underperforming it has been, but over the past couple of days, especially as I think the president contracting COVID, there's been a little bit more interest in healthcare. There's a little more interest in some of the pharmaceutical names here. So what we really see is, what we're really seeing here is potential strength starting to gather a little bit more strength here in some of the healthcare and biotech names. So whether you're looking at IBB, if you're looking at XLV, we're seeing a little bit of strength here. If XLV can get back above 107, that'll put 110 back in the picture fairly quickly. That means that it's back into this long-term bullish trend here. As you can see, those are the February highs. It broke back above that back here in early in the rally. It came back to retest it and actually managed to break back above it. So again, XLV, one that I'm paying attention to for a potential breakout here. So we're seeing a fairly healthy number of sectors show quite a bit of strength, revisiting these all-time highs and testing those resistance levels. That is what you need from the markets in order for them to break out higher. So we are seeing from the individual sectors some of that strength that we're looking for. Technology, still the second strongest sector here in the broader markets here. It is still a little bit away from that recent high here, and quite a bit away from that all-time high. This is really why I think technology is going to have a hard time breaking to all-time highs, because even if it breaks back above this 117.5, 118 level, it still has quite a bit of ways to go to the upside to test that 128 level here to the upside. And especially when we go into this election and we're starting to see a higher probability of a Democratic sweep and a Biden victory, this I think is going to put a cap here on the technology rally, because that outcome of the election is one of the worst outcomes for technology, because technology is at risk of